The perpetual hunt for yield is bigger as ever in this low-rate world. Here to look at some of the high-yield dividend ETFs that are actually yielding more than corporate bonds is Eric Balchunas, Senior ETF Analyst at Bloomberg Intelligence. Eric, as always, thanks for taking the time. And, you know, I find this topic to be so interesting. Here we are 8 years after the beginning of the Fed's accommodation. Investors are still looking for yield. And you're saying that there are some plain vanilla, high-yielding dividend ETFs out there that are actually more attractive than corporate bonds. Can you talk to us about those?
Yeah, look, and I'm riffing off of a great deck that our equity strategy team put out, basically saying, look, within the S&P 500, there's about 80 stocks yielding more than 3.1%, which is what an investment-grade bond, corporate bond will give you. And so I looked at what ETFs to play it, and there's one that literally holds those 80 stocks, and that's SPYD. It's the Spider S&P High Dividend ETF. Holds those 80, but there is one key thing to note is that it equal weights those stocks. That means you juice up on your yield a little because you're tilting into smaller size large caps. You also have 22% REITs, which definitely helps. It's also going to be a little more volatile because of that equal weighted exposure. But certainly it's got a 4.4% yield, well ahead of corporate debt. And then there's one that does something similar, but actually lowers the vol. And that's the S&P 500 High Dividend Low Vol ETF, SPHD. That one's a monster at $3.3 billion. But the fastest growing one in the whole lot is VYM. It's the Vanguard High Dividend. It only yields 2.9%, but it's very safe. It has no REITs, and it generally has sector bands very similar to the S&P 500, whereas the other ones tend to tilt into utilities and have a little less tech, as you can imagine. But all of these are taking in decent amount of cash because of what you just said. People still want income.
So something that really stands out to me, Eric, is the fact that some of these dividend ETFs that you just talked about are actually yielding more than junk bonds. That's pretty amazing. I guess it speaks to as much as what's happening for the fixed income markets as it does for these ETFs. But if you could talk to us about that.
Yeah, so I did a screen. How many are actually yielding more than HYG, which is yielding a little over 5%? There's 5 dividend ETFs that are yielding more than 6% even. The big thing you have to look at here, these basically have a mandate to go anywhere and just get me a lot of yield. They have a lot of REITs. All of them have like over 20% REITs, and a lot have small caps, which tend to yield more. You also have a dose of MLPs in here. But again, the thing with these is these are going to be a little more rate sensitive to some of the earlier ones. But some of these, again, they have really juicy yields, and they also take in money. But again, there's, with everything that's a reward, there's some risk that goes along with it. And that chart, I think, shows you the risk you're taking with these.